January 23rd, 2026, the financial world changed forever. Silver, the poor man's gold, shattered the triple-digit ceiling, hitting an impossible $103.45. But if you're a retiree holding your life savings in a standard 401k or IRA, you aren't celebrating. You are in the crosshairs. While the headlines are cheering this 215% rally, a silent kill switch has just been flipped behind the scenes. Right now, for every 100 ounces of silver promised on paper to retirees across America, only 11 physical ounces actually exist in the vaults. This isn't just a price spike, it's a mathematical trap that's about to snap shut when the markets open this Sunday night. The banks are currently trapped in a 52-hour blackout with no way to cover their billion-ounce short positions. China has pulled the plug with a total export ban. And if you think you own silver because you see a ticker symbol on your phone, you might be about to receive a cash settlement for a price that no longer exists in the real world. Today, I'm showing you the silver iron curtain data that most financial advisors are too afraid to touch. I'm going to prove why this weekend is the final 48-hour window to secure your purchasing power before the Monday gap changes everything. If you've spent 40 years building your nest egg, you cannot afford to miss the next 10 minutes. Subscribe right now and hit that notification bell. We are entering the triple-digit era, and the rules of retirement just changed forever. Let's look at the evidence the banks don't want you to see. First, the desperate measures to stop the rally. The CME group, the exchange where silver futures trade, has been pulling out every trick in their playbook to slow this surge down. They've raised margin requirements 7 times since November, forcing traders to put up more and more cash just to hold their positions. By Friday afternoon, the margin requirement had exploded to $32,500 per contract. That's a staggering amount of capital just to control 5,000 ounces of paper silver. The strategy was obvious: choke off the buying pressure by making it too expensive to play. But here's what should grab your attention. It didn't work. Despite the CME essentially tripling the cost of entry, silver kept climbing. According to data from the Commodity Futures Trading Commission, open interest actually increased by 17% in the final week before the breach. Traders weren't backing down. They were doubling down. And that tells you everything you need to know about what's really happening in this market. Now, let me put this in perspective using a scenario you can actually relate to. Imagine you sold your neighbor 100 promises to deliver physical silver coins next month. You collected his cash up front, confident you could buy the silver later at a cheaper price and pocket the difference. That's essentially what the major banks have been doing in the futures market for years. Except here's the problem. Your neighbor just showed up early, and he brought 99 of his friends with him. They all want their silver right now, and you don't have it. You never actually bought it because you were betting the price would drop. That's the situation the banking system woke up to on Saturday morning, January 24th. The markets are closed. There's no trading, no escape hatch. Just this brutal weekend blackout where short sellers sit paralyzed watching the clock tick toward Monday's opening bell in Asia. The entire COMEX registered inventory, which represents the silver actually available for delivery against futures contracts, dropped to just 43 million ounces by the end of December 2025. That 100 to 11 ratio you just heard about, that's the reality playing out in the vault data right now. Have you checked your IRA or 401k lately? If you own silver through an ETF, a paper certificate, or pooled storage account, you need to understand what's about to happen. The financial industry has a polite term for it: cash settlement. What that really means is this: when the music stops and there's not enough physical metal to go around, your broker gets to decide that instead of delivering your silver, they'll just write you a check based on whatever price they feel like using. You don't get a vote, you don't get an appeal. You signed the agreement that gave them that right, buried somewhere in page 17 of your account disclosure forms. The World Gold Council released data just 2 weeks ago showing that institutional demand for precious metals has reached levels not seen since the currency crisis of 1971. But here's the critical difference. Back then, people had weeks or months to react. This time, the door is slamming shut in real time. Dealers across the country are already reporting back orders stretching 6 to 8 weeks. That's not a supply chain hiccup. That's a system running on empty while demand goes vertical. Think about this scenario. You're 68 years old. You've got $200,000 in your retirement account, and you decided to allocate 20% of it to silver because you were worried about inflation and dollar weakness. Smart move, or so you thought. You own $40,000 worth of SLV, the big silver ETF. You log into your account Monday morning and see the price at $115 per ounce. You're thrilled. You've made a fortune on paper. Then you try to convert that position into physical silver coins, and reality hits you like a freight train. First, you'll face immediate tax consequences because selling your ETF position is a taxable event. Second, even if you're willing to pay the tax bill, you now have to find someone who will actually sell you physical silver at the current spot price. Except the local dealers are quoting $135 per ounce for American Silver Eagles with a 6-week wait. Online dealers are either sold out or showing delivery dates in March. The disconnect between paper price and physical availability has become a chasm you can't cross with a checkbook. This is what I mean by the paper trap. According to recent filings analyzed by precious metals researchers, several major silver ETFs hold significant portions of their assets in unallocated accounts with bullion banks. Unallocated means you don't own specific bars with serial numbers. You own a claim on a pool of metal that the bank is simultaneously lending out to multiple parties. It's fractional reserve banking applied to precious metals. When the price spikes and everyone rushes for the exit at once, the mathematics become impossible. This weekend is different from every other moment in silver market history because it combines 3 factors that have never occurred simultaneously before. A triple-digit spot price that triggers institutional FOMO and retail panic buying, a complete collapse in available COMEX inventory to levels that make delivery against existing contracts mathematically impossible, and this 52-hour period where short sellers are trapped without any ability to cover or hedge their positions before Asian markets reopen Sunday night. The Shanghai Futures Exchange opens Sunday evening at 6 p.m. Eastern Time. That's when price discovery moves from New York to Asia, and that's when the real panic begins. Chinese industrial buyers, Indian wedding season demand, and Middle Eastern wealth preservation all converge in a market that has already been drained of physical supply by Western investment demand. The gap up, when trading resumes, could be catastrophic for anyone caught short. Here's the mathematical reality facing the banking system right now. If just 10% of paper silver holders decide they want physical delivery instead of cash settlement, the entire derivatives structure collapses. There simply isn't enough metal to satisfy those claims. The U.S. Mint reported selling out of 2026 Silver Eagles in the first 3 weeks of January, producing a record 7 million coins that evaporated into private hands almost instantly. Global mints are running triple shifts and still can't keep pace with demand. This isn't theory or speculation. This is Friday afternoon reality backed by exchange data, mint production figures, and warehouse inventory reports. The warning signs have been flashing red for months, but most people don't pay attention until it affects their personal financial situation. By then, it's usually too late to act. The question you need to ask yourself this weekend is simple. Do you own actual silver you can hold in your hand? Or do you own a promise from a financial institution that might not be able to keep it when millions of other people show up demanding the same thing? Monday morning is coming. The Asian markets will open Sunday night, and somewhere in the back offices of major banks, risk managers are having conversations about how to manage a short squeeze in a market where the physical commodity has effectively disappeared from the available supply. Your retirement account might show a silver position, but can you actually touch it? Because if the answer is no, you're not really an owner. You're an unsecured creditor standing in a very long line. Now let me show you exactly why this physical shortage isn't coming. It's already here, and the proof isn't hidden in some conspiracy theory form. It's sitting in official government documents, export data, and warehouse receipts that anyone can verify. January 1st, 2026. While Americans were nursing New Year's hangovers, the Chinese government quietly activated the most significant commodity control mechanism since OPEC's oil embargo in 1973. The China export licensing system for refined silver went live at midnight Beijing time, and with the stroke of a regulatory pen, 60% of the world's refined silver supply suddenly became unavailable to Western markets. Think about what that actually means in practical terms. China doesn't just produce silver. They refine it, process it, and turn it into the high purity bars and granules that industry requires. According to the China Non-Ferrous Metals Industry Association, Chinese refineries processed approximately 600 million ounces of silver in 2025. That's more than half of total global refined output. Now imagine that entire supply chain just stops feeding the Western Hemisphere. The licensing system works like this. Any Chinese company wanting to export refined silver products must now apply for government approval on a shipment-by-shipment basis. The application process takes minimum 14 business days. Approval is discretionary and can be denied without explanation. And here's the kicker. Approvals are being granted almost exclusively for strategic technology partnerships and bilateral trade agreements that favor Chinese industrial policy goals. If you're an American mint trying to source silver blanks, or a European dealer attempting to restock inventory, you're simply not getting approved. Pop quiz. Where do you think the silver in your American Silver Eagle comes from? You probably assume it's mined in the United States, refined in the United States, and stamped into coins entirely on American soil. The reality is far more complex. While the U.S. Mint must source domestic silver by law for bullion coins, the refining capacity in North America cannot meet total demand. Refineries routinely supplemented domestic mine output with imported refined silver, much of it from China. That pipeline just got cut off. The Silver Institute released preliminary data 3 days ago showing that Chinese silver exports in the first 3 weeks of January 2026 totaled just 4.2 million ounces. During the same period last year, exports ran at 23 million ounces. That's an 82% collapse in flow. This isn't a temporary disruption. This is a permanent restructuring of global silver allocation. And it happened so quietly that most Americans still don't understand the supply shock that's already baked into the system. Let me connect this directly to your immediate reality. You walk into your local coin dealer on Tuesday morning, wanting to buy 20 ounces of silver eagles to add to your stack. The dealer checks his suppliers and quotes you a 6-week delivery time frame at $130 per ounce, $26 over the current spot price. You ask why the massive premium and delay when spot silver is readily available on the COMEX. He pulls up his supplier portal and shows you the truth. The U.S. Mint is rationing allocations to authorized dealers because they cannot secure sufficient silver blanks. The blanks come from refineries. The refineries that used to supplement domestic production with Chinese imports can no longer access that supply. Walk across town to another dealer, and the story gets worse. Canadian Maple Leafs, 8 weeks out at $128. Generic 1-ounce rounds, 4 weeks at $118. Even junk silver bags, pre-1965 U.S. dimes and quarters that contain roughly 715 ounces of silver per $1,000 face value bag, are trading at 17 times face value when they should be closer to 14 times based on melt value. The premium compression that usually exists between premium coins and generic products has collapsed because everything is in short supply. Online dealers are implementing purchase limits. SD Bullion updated their website Friday afternoon, restricting customers to maximum 100 ounces per order for silver eagles. AppMex shows delivery estimates sliding from 3 weeks to 6 weeks on most products. JM Bullion's inventory counter shows sold-out status on 42% of their silver product catalog. These aren't mom-and-pop shops running low. These are the largest precious metals dealers in America, and their shelves are emptying in real time. This is the silver iron curtain in action. It's not about price manipulation anymore. It's about physical availability being severed from paper price discovery. The COMEX can quote $103 all day long, but if you cannot actually obtain metal at that price within a reasonable time frame, then that quote is fiction masquerading as market reality. Now layer in the structural deficit that's been building for 5 consecutive years. The Silver Institute's World Silver Survey, published annually with data from metals consultancy Metals Focus, documented a supply deficit of 148.9 million ounces for 2025. That's the 9th consecutive year global demand exceeded mine supply. But here's what should terrify anyone paying attention. The cumulative deficit over the past 5 years now totals 794 million ounces. Let me put that in perspective. You can visualize. Global mine production runs approximately 830 million ounces per year. That means in just 5 years, the world has consumed the equivalent of almost 6 years of mining output beyond what was actually produced. Where did that extra metal come from? Existing above-ground stockpiles, government reserves, and recycled scrap. All finite sources that have been systematically depleted while industrial demand keeps accelerating. Have you noticed how many solar panels are going up in your neighborhood? Each one requires approximately 20 grams of silver for the photovoltaic cells that convert sunlight into electricity. That might not sound like much until you scale it. The Solar Energy Industries Association reported that U.S. solar installations in 2025 reached a record 46 gigawatts of new capacity. That's equivalent to roughly 123 million solar panels. Multiply 20 grams times 123 million panels, and you're looking at 2,460 metric tons of silver consumed just in American solar installations last year. That's 79 million ounces sucked into rooftop and utility scale arrays that will never return to the market. Now multiply that across global solar deployment. China alone installed over 217 gigawatts of solar capacity in 2025, according to the National Energy Administration. Europe added 72 gigawatts. India 45 gigawatts. Each gigawatt consumes approximately 1.7 million ounces of silver. The math becomes staggering when you realize solar is projected to double again by 2030 as countries race toward net zero emissions targets. But solar is just one piece of the industrial demand puzzle. Your smartphone contains approximately 0.2 grams of silver in its circuitry and connections. Seems insignificant until you remember that manufacturers shipped nearly 1.4 billion smartphones globally in 2025. Electric vehicles use between 25 and 50 grams per vehicle for battery management systems, charging components, and electrical contacts. Global EV sales hit 14 million units last year and are projected to reach 22 million by 2027. Then there's the AI revolution that nobody's talking about from a silver perspective. Data centers powering artificial intelligence require massive electrical infrastructure with silver-bearing switches, connectors, and cooling systems. Microsoft announced plans to build 50 new AI data centers over the next 3 years. Google, Amazon, and Meta are in similar expansion mode. Each facility consumes tons of silver in its initial construction, and unlike investor bars sitting in a vault, that industrial silver is gone forever, locked into equipment with 15 to 20-year life cycles. But mine production isn't keeping pace. According to S&P Global Market Intelligence, primary silver mine output actually declined 1.4% in 2025 due to ore grade depletion at major deposits in Mexico and Peru. New discoveries aren't replacing exhausted reserves. The lead time from discovery to production for a major silver deposit averages 12 to 15 years. Even if companies started drilling tomorrow, the supply won't hit the market until 2038 or later. Here is a reality that mining executives don't advertise. 70% of silver comes as a byproduct of mining other metals like copper, lead, and zinc. That means silver supply is largely dependent on the economics of base metal mining, not silver prices alone. When copper mines reduce production because copper prices weaken, silver output falls too, regardless of how high silver prices climb. The primary silver miners who could theoretically ramp up production in response to higher prices only account for about 30% of global supply, and they're constrained by geology, permitting delays, and capital availability. What about recycling? Couldn't that fill the gap? Here's the uncomfortable truth. Silver recycling rates have been falling, not rising. The Silver Institute estimates that only about 23% of silver consumed annually gets recycled. Why so low? Because much of the silver used in electronics, solar panels, and industrial applications is dispersed in such small quantities that recovery is economically unfeasible. It costs more to extract 0.2 grams of silver from a discarded smartphone than that silver is worth. So it ends up in landfills or incinerators, permanently removed from the supply chain. The recycling that does occur comes primarily from photography, jewelry, and silverware, markets that have been declining for decades as digital photography replaced film and younger generations don't buy sterling silver tea sets. In 1990, photography consumed over 200 million ounces of silver annually. By 2025, that number dropped below 15 million ounces. That's 185 million ounces of annual recycling supply that simply vanished as the industry went digital. So we're consuming more, producing less, and the strategic reserve that buffered the gap for the past decade is now effectively locked behind the China export licensing system. This is the mathematical reality that makes the paper-to-physical disconnect inevitable, not speculative. Here's where it gets even more revealing. The Shanghai Futures Exchange, where physical silver trades in China's domestic market, is now showing a $12 premium over the New York paper price. Think about what that's telling you. In China, where you can actually get physical delivery without the settlement games, buyers are willing to pay $115 for the same ounce of silver that is supposedly available in New York for $103. This phenomenon is called backwardation, and in normal commodity markets, it's impossible to sustain. Arbitrage traders would immediately buy the cheap silver in New York, ship it to Shanghai, and sell it for the $12 profit. Except they can't. The export licensing system prevents that flow. So you end up with two completely separate markets for the same commodity. A paper market in the West trading on perception and leverage, and a physical market in the East trading on actual supply and demand fundamentals. The Shanghai premium has been widening since mid-December, according to data from the Shanghai Gold Exchange. It started at $3 per ounce, then $6, then $9, now $12 and climbing. Each dollar of premium represents another layer of confirmation that Eastern buyers have completely decoupled from Western price discovery. They're not waiting for COMEX to tell them what silver is worth. They're paying whatever it costs to secure physical metal before the available supply disappears entirely. Indian wedding season demand is about to compound this pressure. The India Bullion and Jewelers Association reported that silver imports during the traditional wedding months of February through April typically exceed 100 million ounces. Indian buyers purchase physical metal for jewelry, gifts, and wealth preservation. They don't trade paper contracts. They want bars and coins they can see and touch. Where exactly is that 100 million ounces going to come from when Chinese exports have collapsed? COMEX registered inventory is sitting at 43 million ounces, and Western mints are already 6 weeks behind on delivery. Middle Eastern sovereign wealth has started rotating into precious metals as insurance against currency instability. The World Gold Council documented record gold purchases by central banks in 2025. But institutional buyers are also diversifying into silver as the gold-to-silver ratio approaches historical reversion points. When funds managing hundreds of billions start allocating even 1 or 2% to physical silver, they're competing for supply against industrial users who absolutely must have the metal to manufacture their products. This is the supply-demand vice that's been tightening for months. while most Americans focused on stock market headlines and interest rate speculation. The structural deficit isn't a prediction, it's documented history. The China export licensing system isn't a rumor, it's codified regulation published in official government registries. The Shanghai premium isn't manipulation. It's the free market telling you what physical silver actually costs when you remove the paper leverage and settlement games. Every data point confirms the same conclusion. The global silver market has fractured into two separate realities. There's the leveraged paper market where banks trade promises and hope nobody actually demands delivery. And there's the physical market where real buyers compete for dwindling supply at prices that reflect actual scarcity. Friday's breach past $100 wasn't the beginning of this crisis. It was the moment when the paper market finally started catching up to the physical reality that's been building for years. Your retirement account exists in the paper world. The question you need to answer this weekend is whether you're comfortable staying there when the gap between paper promises and physical delivery is widening by the hour. Now let's talk about where this price is actually heading, because the mathematics aren't speculative, they're already in motion. And if you understand what's about to happen when Asian markets open Sunday night, you'll realize why this weekend represents the final chance to act before the gap becomes unbridgeable. Gold is sitting at $4,972 per ounce as of Friday's close. That number should matter to you even if you don't own gold, because the relationship between gold and silver has remained surprisingly stable throughout history. The gold to silver ratio measures how many ounces of silver it takes to buy 1 ounce of gold. For centuries, that ratio averaged somewhere between 15 to 1 and 20 to 1. In modern times, it's typically ranged between 50 to 1 and 80 to 1. Right now, with gold near $5,000 and silver at $103, the ratio sits at 48 to 1. Here's what you need to understand. Every major precious metals cycle in the past 50 years has seen in this ratio compress violently toward historical norms, when silver begins outperforming. In 1980, it hit 15 to 1. In 2011, it briefly touched 32 to 1. We're watching that compression happen in real time right now. What happens if the ratio moves to 40 to 1 over the next 8 weeks? Simple division gives you the answer. $5,000 gold divided by 40 equals $125 silver. That's not a prediction pulled from thin air. That's mathematical reversion to a ratio that's held for decades. And here's the critical insight. Gold doesn't need to do anything dramatic from current levels. It just needs to hold near 5,000 while silver catches up. But there's another calculation that matters even more for understanding where price must go to clear the physical market. Industrial users of silver have been paying premiums above spot for months to secure guaranteed supply. According to interviews with purchasing managers at solar manufacturers published in industry trade journals, companies are now signing contracts for 2026 delivery at fixed prices between $130 and $145 per ounce. Think about what that reveals. These aren't speculators gambling on price direction. These are manufacturing operations that will shut down production lines if they can't secure raw materials. They're telling you through their procurement decisions that $103 silver is not real for anyone who actually needs physical delivery. The fair value for silver, adjusted for industrial demand that cannot be delayed or substituted, sits somewhere between $125 and $150 by the end of the first quarter. That's not hype. That's what corporations are actually paying right now in private contracts to lock in supply. The spot price simply hasn't caught up yet to the physical market reality. Now add in the forced buying that's about to hit the market Sunday night. The COMEX has January contracts expiring on January 28th. That's this Tuesday. Contract holders who want physical delivery must notify the exchange by first notice day, which already passed. But short sellers who are stuck in losing positions have to either deliver metal they do not have or buy contracts to close out their positions before expiration. With a holiday weekend limiting their ability to maneuver, they're trapped. Asian markets open Sunday evening at 6 p.m. Eastern Time. That's when the Shanghai Futures Exchange and the Tokyo Commodity Exchange start trading for Monday. Based on the weekend gap pattern we've seen in other commodities during short squeeze events, analysts tracking the silver market are projecting an opening gap of $9 to $12. That would put the initial Asian quote somewhere between $112 and $115 before New York even wakes up Monday morning. Here's why that gap matters for your retirement account. If you're holding SLV or another silver ETF, your position is marked to market based on the spot price. But the spot price you see quoted is based on the most recent COMEX settlement, which was Friday afternoon at $103.45. When markets reopen and price gaps up $10 instantly, your account value will reflect that gain. You'll see $113 silver or higher, and you'll feel wealthy on paper. But if you try to convert that paper wealth into physical metal, you'll discover that dealers are quoting $140 with 8-week delivery delays. The spread between paper gains and physical access will be devastating. Let me walk you through a specific scenario that's going to play out for thousands of retirees this week. You're 72 years old. You've got $300,000 in your IRA. You allocated 15% to precious metals last year when silver was at $60. That position is now worth roughly $77,000 based on Friday's close. You wake up Monday morning and see silver at $115. Your position is now worth $86,000. You're ecstatic. You decide to take profits and lock in your gains. You call your broker or log into your account and place a sell order. The ETF shares sell instantly at the current net asset value. You've now got cash in your account, but you've also triggered a taxable event, and you're concerned about dollar weakness, so you decide to roll those profits into physical silver coins that you can store yourself. You contact 3 different online dealers. All of them quote delivery times of 6 to 10 weeks. All of them quote prices between $135 and $142 per ounce. You've just sold your exposure at $115, and you cannot rebuy physical metal anywhere close to that price. This is the paper-to-physical trap in its purest form. Your retirement account exists in a digital ledger that can be settled in cash at prices that no longer reflect physical market reality. According to the prospectus language that governs most silver ETFs, the fund sponsor reserves the right to settle redemptions in cash rather than physical metal if they determine that physical delivery is impractical or would disadvantage remaining shareholders. That's legal boilerplate that most people never read. It means when push comes to shove, you get a check, not a bar. The Bank for International Settlements published a working paper in late 2025 examining systemic risks in commodity derivatives markets. One of their key findings: when physical commodities become scarce, the settlement mechanisms that underpin paper markets can break down rapidly, leaving investors with cash settlements that don't reflect actual replacement costs. They were writing about lessons from the nickel short squeeze on the London Metal Exchange in 2022. But the same dynamics apply to any commodity where paper contracts vastly exceed physical supply. What should terrify anyone holding paper silver is this simple reality: there is no mechanism to force the financial system to deliver physical metal if it does not exist. Courts have consistently ruled that commodity ETFs and futures contracts can be cash settled without constituting fraud, as long as the settlement is based on a recognized price index. The COMEX spot price is that index. But if the COMEX spot price is trading at $115 while physical metal is trading at $140 in the dealer market, which price do you think the ETF will use for your cash settlement? Sunday night's opening is going to reveal just how disconnected these markets have become. Traders who've been following silver for decades say they've never seen setup conditions this extreme. The short interest, the physical shortage, the weakened gap, the expiring contracts, the China export ban. It's a perfect storm of factors that normally don't converge. When they do, markets don't trade in orderly fashion. They gap violently and leave casualties behind. Here's the final calculation you need to understand. If you cannot take physical possession of your silver by Monday morning, you need to ask yourself a hard question. Do you own an asset or do you own a promise? Because in the world we've entered as of Friday, January 23rd, those two things are no longer the same. Ownership means you can walk to a safe, open it, and touch your wealth. Ownership means your security does not depend on the solvency of a financial institution or the integrity of a settlement system under stress. Ownership means when prices gap up and markets get chaotic, you're not at the mercy of force majeure clauses buried in account agreements you signed years ago. If your silver exists only as a ticker symbol on a screen, you're not an owner. You're an unsecured creditor in a system that has promised the same ounce of metal to multiple parties simultaneously. When that mathematical impossibility finally resolves, some people will get paid in cash at yesterday's prices. Some people will wait months for delivery at tomorrow's prices. And some people will hold physical metal that they already control, watching the chaos unfold from a position of security rather than dependence. The triple-digit era has arrived. The China export licensing system has redrawn the global supply map. The structural deficit has finally exhausted the strategic stockpiles that buffered the market for a decade. The gap between paper prices and physical availability is now measured in weeks and tens of dollars, not hours and pennies. You've spent 40 years building your nest egg. You've made sacrifices, saved diligently, and planned for a retirement where your money would be there when you needed it. The question this weekend is whether that money exists in a form you can actually access when the system is under stress, or whether it's just a database entry that can be converted to cash at the institution's discretion. Monday morning is 18 hours away. The Asian markets will tell us whether the weakened gap predictions were conservative or optimistic. Either way, the world's financial markets are about to discover what happens when a commodity that is essential to modern industry becomes unavailable at any price the paper market is willing to recognize. The silver iron curtain isn't coming. It's already here. The only question left is whether you're on the right side of it when the full implications become undeniable to everyone watching. Your move.